Okay, now come to next point. Compound financial instrument. Compound financial instrument means those instruments which include both equity and debt. So under IAS 32, a compound financial instrument needs to be divided into debt and equity part. Debt will be accounted separately because it becomes a financial liability. Equity will be accounted separately. But what about those compound instruments which the company had already issued prior to transition date? Okay, because very few standards may apply the same rule of compound financial instrument as given in IFRS. So previous GAAP may not divide into debt and equity. They may just simply keep on accounting it like a debt instrument only. In accounting for financial instrument, it is a requirement where a financial instrument combines a liability and equity element. For example, a debenture with convertible option in the hands of the holder. The amount of these two component, that is your debt and equity, two component means debt and equity, including tax effect, shall be presented separately. So in the first line they have revised what is to be done. But because we are moving from previous GAAP to IFRS, in the previous GAAP this may not have been done. So you are given an optional exemption here. Either you can do this retrospective calculation or you can just do prospective calculation. However, in accordance with IFRS, a first time adopter need not separate these two portions. If the liability component is no longer outstanding at the date of transition to IFRS. Liability component means that portion of this instrument which requires payment of cash and that cannot be avoided. Okay. So though that much cash which cannot be avoided has been paid by you, then in that case there is no need to find out the liability portion because liability portion is over. However, it also means that in case if the liability is outstanding, then in that case the liability portion will be separated and equity portion will be separated. Now this will come under reclassification on the date of transition. Before date of transition it was appearing as one instrument. After date of transition it will appear as two instruments if the liability component is outstanding. Now next is investment in subsidiaries, associate and joint ventures. This is for separate financial statement. When separate financial statements are prepared by an entity, investments are accounted either at cost. This you have learnt in which standard? IAS 27, or in accordance with IFRS 9, or using equity method as described in IAS 28. But this is as per IAS 27 rule. Previous GAAP may not be following these three rules. So in previous GAAP they must be carrying it at some cost. So what the standard says, for the purpose of cost, the cost may be the cost as per IAS 27 or a deemed cost which can be fair value on the date of transition or previous GAAP carrying amount. So what is cost on the date of transition? Three options are given to you. Cost as per IAS 27 calculated as deemed cost, which may be fair value or which may be previous GAAP carrying amount also. Okay. So previous GAAP carrying amount can be treated as cost for the purpose of IAS 27, or fair value on the date of transition can be treated as cost for the date of transition purpose. So what will you do if you are the manager? Carrying amount, why to apply unnecessary headache? Is it right? When that option is there. Of course, companies will do their own analysis and see which is more beneficial for them. Then next is assets and liabilities of subsidiaries, associates and joint ventures. Now this is also interesting. This standard envisages situations where subsidiary becomes first time adopter later than the parent, or parent becomes the first time adopter later than the subsidiary. Okay. Small circle. Parent, subsidiary. Case 1. Parent started applying from say 1/4/20 and subsidiary from 1/4/21. Second example, parent became first time adopter on 1/4/21 and subsidiary had already became first time adopter on 1/4/2020. Is it right? Now the problem is, when subsidiary becomes first time adopter later than the parent, what would be the carrying amount of assets and liabilities on the date of transition? Or in this case, what would be the carrying amount on the date of transition? So therefore, there are two paragraphs dedicated for that purpose. First example, parent transits to IFRS first. Parent had become first time adopter on 1/4/20. Subsidiary became afterwards 1/4/21. The question is how the subsidiary's assets and liabilities will be measured. Where the subsidiary becomes first time adopter later, the carrying amount of the assets and liabilities would be either, now here there is a choice given to you, either carrying amount that would be taken for parent's consolidated financial statement duly adjusted for consolidation and effects of business combination. Now I'll go to the previous diagram. Parent has already started consolidating the subsidiary from 1/4/2020. So what one option is, whatever figures the parent has taken here, those figures will be treated as the carrying amount of the subsidiary subject to any adjustment for consolidation and effect of business combination, or as usual carrying amount as required by other IFRS based on the date of transition of subsidiary. So basically this is in any case you can follow, which is usual provision of the standard carrying amount as per other IFRS. But one more option is there. You can choose the carrying amount that was taken for parent CFS purpose duly adjusted for consolidation and effect of business combination. Because you have already started consolidating and you have learnt in IFRS 10 the parent's accounting policy and subsidiary accounting policy would be the same, and some fair value adjustment which was supposed to be done has already been done. This option is available in case of associate and joint venture also. So even if it is associate and joint venture, you will follow the same. Next possibility, subsidiary transits to IFRS first. In this case, the parent becomes first time adopter later than the subsidiary. The assets and liability of subsidiaries shall be measured at the same carrying amount as in the subsidiary's financial. So no major changes here. You continue to follow whatever you have done because you have already moved to IFRS. However, adjustments are required for consolidation and for business combination in which the parent had acquired the subsidiary. But for the purpose of consolidation and business combination, adjustment will be made. Para 23, service concession arrangement. Now here I have not gone into details, I have written only one line. First time adopter may apply the transitional provision given in IFRIC 12. This we had a discussion in which standard? IFRS 15. Okay. Next is leases. Now IFRS 16 is applicable for leases. So talk only about IFRS 16 now, right? And in this IFRS 16, you have to identify whether lease exists in a contract. Whether a lease exists in a contract. So that assessment will be done on which date? On the date of transition. Whatever you have done previously, you continue to follow that. Okay. And then leases accounting also gives you the transitional provision. Lease accounting IFRS 16 also gives you transitional provision, how you will move from old GAAP to new GAAP or old IFRS, but that was also old IFRS. A first time adopter may assess whether a contract existing at the date of transition to IFRS contains a lease on the basis of facts and circumstances existing at that date. So now you have to read all the agreements carefully on the date of transition. So life of CA would be difficult. Read so many agreements and check whether there is any lease contract, okay, in a given contract. So contract may look like something, but it may contain some lease agreement also. Is it right? Next is decommissioning liabilities included in the cost of property, plant and equipment. Now on the left side on the screen, we will discuss the provision of two standards, IS 16 and IS 37. And then on the right side, we will see what is the exception allowed to you. So what is IS 37? In case if you have PPE, then the cost of the PPE will be determined considering the obligation relating to decommissioning cost, restoration cost and similar cost, cash flow in respect of which is expected to occur at a subsequent date and not at the time of installation of the asset. So what we have done in this IS 37 and IS 16, estimate the decommissioning obligation, compute the present value, adjust in the cost of the PPE. Subsequently, if there is a change in the liability, okay, then we have to make adjustment in the cost of the asset also. Not because of unwinding of discount, but because of change in the estimation of liability, change in discount rate. Then in that case, we will adjust the liability amount also, asset amount also. This is also given in IS 16. We have taken some problems also on that. But there is an exception. And what is that? A first time adopter need not comply with this requirement of remeasurement of liability, underline that, occurred before the date of transition. Whatever has happened before the date of transition in the change of liability, ignore it. You have an option to do that. If a first time adopter uses this exemption, it shall measure the liability at the date of transition to IFRS in accordance with IS 37. So you have an option not to do retrospective calculation of the liability, but you can check the liability on the date of transition and then do the adjustment required. Now next 3-4 items I have put together only. Insurance contract, transfer of asset from customer, extinguishing financial liabilities with equity. So what is one line answer? This requirement shall be applied prospectively. Retrospective application is encouraged. Sir, what do you mean by encouraged? If you want, you can do it. Okay, otherwise not. Now revenue from contract with customer, IFRS 15. For completed contract as on the date of transition, IFRS 15 need not be applied. For those contracts which have been completed, IFRS 15 need not be applied from retrospective effect. But those contracts which are in the progress stage, you have to apply IFRS 15. A completed contract is a contract for which entity has transferred all the goods or services identified in accordance with previous GAAP. So contract which have been completed on the date of transition, this standard is not applicable. Now next is, we have almost come to the end of this chapter, interim financial statement. Is the standard also applicable to interim financial statement? Why? See on the screen left side. Suppose my first Ind AS financial statement period covers 1/4/2020 to 31st March 2021. This is what we have decided. So the moment you say now this IFRS I am going to apply, first quarter of this financial year covering 1/4/2020 to 30th June 2020, this will also be based on IFRS. If this you have to prepare, you have to give a comparative also. Say for example, for profit and loss account, the comparative figure will cover 1/4/19 to 30th June 19, and there is one opening SOFP also required as on 1/4/19, opening SOFP will be required. So that means the same entire standard 101 now will be applied for this first interim financial statement also, because there also I require opening balance sheet, I require P&L account, I require cash flow statement, I require a balance sheet on 30th June 20 and 30th June 19. Is it right? So the standard becomes applicable to that interim financial statement also, which will fall in that first financial period, first IFRS financial period. So what are the requirement? An entity presents interim financial report as per IAS 34, that you know, for part of the period covered by its first IFRS financial statement, then it shall comply with the following requirement. A reconciliation of its equity, because equity is the item which will undergo a change from previous GAAP to IFRS, because all adjustments will be routed through equity. A reconciliation of its equity in accordance with previous GAAP at the end of the interim comparable period under IFRS as on that date. So reconciliation of equity, previous GAAP and IFRS at the end of the interim comparable period. A reconciliation to its total comprehensive income in accordance with IFRS for that comparable interim period, because previous interim period was already finalized under old GAAP. For comparison purpose, you have to give under IFRS. So the difference between the two comprehensive income would be there. This comprehensive income under old GAAP has to be reconciled with the comprehensive income under IFRS. In addition, it shall also present the reconciliation required for its comparatives. So for all the comparatives, reconciliation will be given. SOCI, total comprehensive income. And now this is the main financial statement. What are the presentation and disclosure requirement for the annual financial statement now? A first time adopter is required to present statement of reconciliation to disclose the movement in equity and comprehensive income. Because previous GAAP equity would be different from this. So you have to take previous GAAP equity and all adjustment that you have done, you have to show it. And how you have reached the opening equity. Similarly, previous comprehensive income and all adjustment done to reflect the comprehensive income as per IFRS. The disclosure would be in the nature of statement showing reconciliation of equity as on the transition date. The statement should highlight each of the constituent elements that impact on equity due to transition from previous GAAP to IFRS. So all important adjustments should be properly highlighted. Highlighted means not the color, but disclosed properly. Okay. So that the users can understand better. A statement of reconciliation of total comprehensive income. So that is also applicable for total comprehensive income, specifying each of the constituent element impacting income statement of the first reporting presented due to transition from previous GAAP to IFRS. This is a disclosure related to P&L account. So you have to do reconciliation of total comprehensive income between previous GAAP and IFRS. And for interim period reports, the above two reconciliations should be given. This I think I have already discussed for the part period and on a year to date basis. What are the statement required? Balance sheet will be for 3 dates. Balance sheet means a statement of financial position as on the reporting date 31st March 2021, immediate previous preceding reporting period 31st March 2020, and as on the transition date 1/4/19. The transition date will be the beginning of the earliest comparative period. The entity will also present 2 statement of profit and loss, current year, previous year, 2 statement of cash flow, current year, previous year, related notes, current year, previous year. Also, the comparative information should be given as per the previous GAAP in addition to the above requirement. This is reconciliation, you can say. Reconciliation. Example. An entity adopts IFRS for financial year ended 31st March 2021. Under this option, the entity will prepare opening statement of financial position on 1/4/19, statement of financial position, statement of profit or loss, cash flow, notes. These last 4 items for year ended 31st March 21 and 2020 as per IFRS. Okay. And you have to give the reconciliation statement also. And reconciliation statement. In addition, the first time adopter is also required to present reconciliation to disclose the movement of equity and comprehensive income. Now we will discuss some of the major changes in Ind AS 101 versus IFRS 1. Now here the list is very long. Why? Because we are India. Lot of exemption we have given to ourselves only. Okay. We were not happy with the exemption they had provided, so we added something more. So one is the definition of previous GAAP under Ind AS 101. In IFRS 1, there is no specific mention of previous GAAP. They have not specified US GAAP, Indian GAAP, Companies Act, etc. They have only said whatever accounting practice you had followed before adopting IFRS. But in Ind AS 101, they have mentioned also that previous GAAP as the basis of accounting that a first time adopter used for its reporting requirement in India immediately before adopting Ind AS. So this is what they have added: reporting requirement in India immediately before adopting Ind AS. The changes made it mandatory for Indian entities to consider the financial statement prepared in accordance with existing notified standard. So basically in India the previous GAAP was notified accounting standards which all entities in India having business, commercial, industrial activity will have to follow. Okay. And then allowing the use of, reason I am not reading, reason you read as homework, because we were subject to Companies Act. So as the Companies Act changes, our standards also that is applicable changes. First Companies Act originally said follow accounting standard. Then they asked you to follow Ind AS, right? In future they may ask you to directly follow IFRS. Okay, possible. And that should be done. Unnecessary. Why to create so many set of standards? Next is allowing the use of carrying amount of property, plant and equipment on the date of transition to Ind AS 101. Now this also I'll just quickly explain. In Ind AS 101, you can simply take existing carrying amount as a deemed cost. Whereas in IFRS, you can either apply IAS 16 or fair value. Okay. Existing carrying amount cannot be taken as it is, because that may be based on anything. Okay. You may not provide depreciation at all also. Now, next point is also very important for you: long-term foreign currency monetary item. Now, I will not read, I will just explain. What is a long-term foreign currency monetary item? That means those monetary item which will fall due more than 12 months from the reporting date. Okay. Like for example, loan taken for more than 12 months. Now, what is the accounting treatment under IFRS? No provision in IFRS 1. No specific separate provision for long-term foreign currency monetary item. Is it right? But in Ind AS, they have added one paragraph called D13AA. This is a very popular paragraph number under Ind AS. D13A. If you have long-term foreign currency monetary item, and if you have followed para 46A of accounting standard, which allows you to defer the exchange difference, then you can continue with the old policy of deferment of exchange difference, but only for those loans which were contracted up to the date of transition. Afterwards, you have to apply Ind AS 21, that means charge to profit and loss account. There is no such similar paragraph in IFRS 1. In IFRS 1, there is no separate logic of long-term foreign currency monetary item. There is no deferment on long-term foreign currency monetary item. Okay. Now next is financial assets or intangible asset accounted for in accordance with Appendix C, that is service concession arrangement to Ind AS 115, revenue from contract with customer. Now what is 115 service concession arrangement? It deals with public-private partnership arrangement, where there is a party called operator. He gets the right to construct or upgrade a public infrastructure, and then he can either disclose this public infrastructure as financial asset or intangible asset. Is it right? Now there is some carve out here between IFRS and Ind AS. As per IFRS, there is a paragraph D 22 of Appendix D to IFRS 1. Provides that a first-time adopter may apply the transitional provision in IFRS 12 for the accounting for financial asset or intangible asset. But this carve out is that paragraph D22. Applying from retrospective effect is a very, again, time consuming and costly affair. So what we have done, we have made a carve out. Paragraph D22 of Appendix D to Ind AS 101 provide that a first time adopter may apply the following provisions while applying the Appendix C to Ind AS 115. So now they have given one extra paragraph here. Subject to paragraph 2, changes in accounting policies are accounted for in accordance with Ind AS 8, that is retrospectively, except for the policy adopted for amortization of intangible asset arising from service concession arrangement related to toll roads recognized in financial statement for the period ending immediately before the beginning of the first Ind AS financial reporting period as per the previous GAAP. Now, if you are going to adopt this Appendix C, it will amount to change in accounting policy. Change in accounting policy as per Ind AS 8, retrospective effect. But here you don't have to give retrospective effect for change in accounting policy, because earlier we used to follow Companies Act for depreciation purpose. Okay. But now you have to follow this IFRS for depreciation or Ind AS for depreciation purpose. So therefore, whatever you have done in the past, it was as per Companies Act, ignore it. Give prospective adjustment. Paragraph 3 of Ind AS 101. Now next heading. Not resulting in carve out. First four are the major carve outs. And these are small differences, so they are not called carve outs. Okay. First financial statement. Paragraph 3 of Ind AS 101 specifies that an entity first Ind AS financial statement or first annual statement in which entity adopts Ind AS in accordance with Ind AS notified under Companies Act. Now, here we have specifically mentioned about Companies Act. Does IFRS also have a similar provision? No. IFRS 1 provides only various examples of first financial statement. IFRS does not give reference of any law. And second, example. These are all minor differences which you can ignore also. IFRS 1 provides various examples of instances when an entity does not apply this IFRS. Okay. That means what is previous GAAP, they have given other examples. Like for example, any internal report presented to the management. That is also previous GAAP. Any previous financial statement which was based on IFRS accounting, but they had never given a statement of reserved compliance. That is also previous GAAP. Or there may be some GAAP which was 50% IFRS based and some percentage some other standard base. These are examples they have given to identify previous GAAP. Ind AS 101 does not provide any example. Now next is what is previous GAAP. Same point they are repeating again and again. IFRS 1 requires the first time adopter shall exclude from its opening IFRS balance sheet any item recognized in accordance with previous GAAP that does not qualify for recognition as an asset or liability under IFRS. This we have discussed in the beginning paragraph today. Whatever do not meet the definition of asset and liabilities under IFRS are not required. De-recognize such item. The first time adopter shall account for the resulting change in the retained earning at the transition date except in certain specific instances where it requires adjustment in the goodwill. In such instances, IFRS 1 allows adjustment in the goodwill. Under Ind AS 101, now under IFRS 1, there can be adjustment only in goodwill for some item. That may be because of business combination related matter. Okay. But in India, we create a reserve called capital reserve. The concept of capital reserve is not there in IFRS. So here we can also adjust in capital reserve to the extent such adjustment amount does not exceed the balance available in capital reserve. Next point 4, optional exemptions. IFRS 1 provides for various optional exemptions that an entity can seek while an entity transitions to IFRS from its previous GAAP. Similar provisions are there in Ind AS 101 also. However, there are few changes that have been made which can be broadly discussed like this. Few changes. Again, these are very minor changes. You can ignore them also in your answer. One is elimination of effective date prior to transition date to Ind AS. Now, I am going to explain this small point. In IFRS 1, there are lot of dates which have been mentioned. But since in India we are adopting it for the first time now only, those dates mentioned in IFRS are not relevant to us. Like for example, in para D2 of IFRS 1, provide that entity is encouraged but not required to apply IFRS 2 to equity instrument that was granted on or before 7 December 2002. Now, do we need to write such dates in our Ind AS? No. Next line. However, for Ind AS 101 purpose, all these dates have been changed to coincide with the transition date only, elected by the entity adopting this converged standard. So, all these dates are equivalent to transition date in Ind AS. Now, deletion of borrowing cost exemption not relevant for India. You should know that there is no borrowing cost exemption in Ind AS 101, but borrowing cost exemption is there in IFRS 1. Why? Because before Ind AS we used to follow AS, and in accounting standard 16 there are similar provisions for borrowing cost. Okay. So therefore, what is mentioned in IAS 23 is more or less followed as it is in AS 16. In AS 16. So therefore, there is a difference in the two standard. Then point number 5, short-term exemption from IFRS. There is an appendix E which we have not read of IFRS 1 provides short-term exemption from IFRS. However, Ind AS 1 does not provide the above said short-term exemption. So not very important. I have not discussed also in the main lecture. Exemption relating to long-term foreign currency monetary item and service concession arrangement relating to toll roads. Ind AS 101, in addition to exemption provided under IFRS 1, also provide certain optional exemption relating to long-term foreign currency monetary item, which I have discussed some minutes back, and service concession arrangement relating to toll roads. Last is business combination. Under Ind AS 101, para C4, subsection C requires first time adopter shall exclude from its opening Ind AS balance sheet any item recognized in accordance with previous GAAP that does not qualify for recognition as asset or liability under Ind AS. The first time adopter shall account for the resulting change in the retained earning as at the transition date, except in some specific cases where it is adjusted in goodwill. Okay. So under IFRS you can adjust only against goodwill. But under Ind AS 101, you can also adjust against capital reserve. I think this was discussed earlier also. If there is a balance in capital reserve, the adjustment can be done under capital reserve also. Now we'll take a small case study. Ready? Case study on how to convert previous GAAP SOFP into IFRS based SOFP. See, case study on adjustment for opening SOFP as per IFRS. You are given one SOFP, you are given some adjustments below, and reading those adjustment and this opening SOFP, you have to prepare SOFP as per IFRS. Okay, not every item needs to be adjusted, only some item. So first let me read the SOFP. PPE, investment property, investment in S Limited, total non-current asset, debtors, lease deposit, advance for purchase of inventory, cash, total current asset, total asset, equity and liability, share capital, reserve, cumulative translation reserve, ESOP reserve, retained earning, total equity, sales tax deferral loan, unearned government grant, creditor, short-term borrowing, provisions, total current liabilities, total equity and liabilities. Then PPE includes land held for capital appreciation purpose rupees 4,50,000. What is the use of this information? This is a reclassification adjustment. Suppose on the screen we have a PP 134 13,450,000. So I'll just remove this 4,50,000 from here and I'll put it under the head investment property. That's it. Will it affect reserve? No. Second, investment in subsidiary. Fair value of the investment in subsidiary as on the date of transition is 68 lakh rupees. So in the separate financial statement we can follow IAS 27, which means we can measure it at fair value. Okay, and fair value is 68 lakh, carrying amount is 48 lakh. So I will increase it to 68 lakh. We will gain 20 lakh. The 20 lakh you tick mark will be adjusted in retained earning. Retained earning figure 1,79,000 will become plus 20 lakh. Second effect of this 20 lakh. Lease deposit. Lease is a cancelable lease and the lease deposit is considered as repayable on demand. Is it presented in current asset or non-current asset? Current asset. That is okay. No adjustment required. Had they shown it under non-current asset, then you will classify to current asset because then it is repayable on demand. Okay. Sales tax deferral loan of rupees 60 lakh is payable at the end of 5th year. The present value is 37,25,528. So what will you do? The present value will be treated as financial liability. Difference amount will be treated as grant. ESOP. As per previous GAAP, 1,000 ESOPs were granted and 800 was already vested on the transition date. And 200 options were not vested on transition date. Those which have been vested don't do anything. Okay, but those who are pending, then we have to do the adjustment. The fair value of such options not vested on the transition date in accordance with IFRS 2 result in an additional ESOP charge of rupees 1000. Tick mark retained earning. Tick mark retained earning, we will reduce 1000. Okay. And tick mark ESOP reserve, which we will increase by 1000. Cumulative exchange difference recognized in FCTR as per previous gap is 1 lakh. You will see cumulative translation reserve note number 4, 1 lakh is appearing. What you have learned today, this will be brought down to 0. And since it is going to be brought down to 0, you will add this 1 lakh in retained earning. Okay. So now we'll prepare SOFP. Check the answer. First item, fixed asset. Fixed asset, write down. Opening as per previous gap 1 crore 34 lakh 50,000. Adjustment in bracket, write 4 lakh 50,000. Therefore, as per IFRS, just change the heading here. IFRS, it will be 1 crore 30 lakh, 13 million. Investment property from 0 to 4 lakh 50,000. This won't affect reserve, it's only adjustment within the two headings. Investment in S Limited 48 lakh given, fair value 68 lakh is given. So this will increase by 20 lakh. Total non-current asset 1 crore 82 lakh 50,000. Total adjustment 20 lakh. Revised total is 2 crore 2 lakh 50,000. Check. Debtor 2 lakh, no adjustment 2 lakh. Lease deposit 1 lakh, no adjustment 1 lakh. Advance for purchase of inventory. Advance for purchase of inventory 50 lakh 0 50 lakh. Inventory 7 lakh 0 7 lakh. Cash 49,000 0 49,000. Take total. Previous gap 60 lakh 49,000. 0. Total current asset no change 60 lakh 49,000. Total asset previous gap 2 crore 42 lakh 99,000. Total change 20 lakh. IFRS column total 2 crore 62 lakh 99,000. Are you checking? Yes or no? It will only increase by 20 lakh. Now see the equity and liability side. Share capital no change 13 lakh dash 13 lakh. Reserve, first you come to this cumulative translation reserve. This we are going to eliminate. So balance will become 0. Then you come to ESOP reserve 20,000. I will add 1,000 because of this unvested option, total 21,000. The important thing to understand is this retained earning. For that, we'll just check that working note printed in your notes at the end. Go to that working note, number 6. Retained earning as per previous GAAP, tick mark 1,79,000. Add increase in fair value of investment 20 lakh. Right, 20 lakh, I think it is written. Minus additional ESOP charge 1,000. And plus transfer of cumulative exchange difference opening balance 1 lakh. Therefore, closing balance 22,78,000. Transfer it to the main answer 22,78,000, final figure. Take total of equity 1,32,99,000 as per previous GAAP. Copy from previous GAAP. 20 lakh is the net addition. Closing 152,99,000. Sales tax deferral loan. What I need to do? Out of the 60 lakh, this amount is financial liability. Rest is government grant. Is the balancing figure 22, 47, 472 or 74? This balancing figure is how much? 60 lakh minus 37, 25, 528. 2274? Unearned government grant, write down the same figure, remove from here and shift it to government grant. Remaining items, no adjustment. Creditor, same 30 lakh, 30 lakh. Short term borrowing, 8 lakh, 8 lakh. Provisions, 12 lakh, 12 lakh. Is the total tallying? Tallied. Explanation is printed below, you can read later. Now this chapter is over.